But well, tomorrow is Teachers' Day, and ahead of that, we at BNSN decided to touch base with Safal Niveshak. He is an investor, he is a teacher as well, traveling across the length and breadth of the country, chatting with students of all age groups. Vishal Khandelwal spoke to us about different trends he's witnessing, what is his investment mantra, and what are some basic checklists that he recommends all the DIY investors out there. Let's listen in.
The first thing which I talk to students or people who want to learn about investing or developing the right mindset is to first know themselves, whether they are attuned to long-term investing, whether they're fine investing for the long term, where they're comfortable letting them compound over a long period of time.
Right. So what are your go-to investing principles? I mean, there are some lessons I'm sure that you really swear by. If you could talk to us about some top 3 or top 4 of your favorites or your go-to lessons.
So I think the very first lesson definitely is to survive. I think if someone wants to really do well in long-term investing, he or she first needs to know how to survive that long-term, right? So like Buffett says never lose money is the only rule of investing. So I think knowing what you should not be doing as an investor is one lesson which I've taken to heart and I practiced for years now. That's one of the most important lessons that I practice and I can teach to anyone. The second is definitely about the power of compounding, the power of long-term compounding, which comes along with patience. So having the right kind of patience to deal with the markets ups and downs over a long period of time, sticking with good quality businesses over a long period of time, and ignoring the short-term volatility. So these couple of principles, and of course the most important principle that is of margin of safety. So we are often unlucky, we often make mistakes, right? Things can go wrong beyond our control, right? So it's very important to have adequate margin of safety or that margin of error when you're investing, and that applies to every area of life as well. So I think these 3 are the most important things for me as investing principles.
All the retail participants that are today entering the market in such a big way, a lot of them happen to be very young traders, first-time traders. So for these guys, how can we emphasize, or as someone who's also looking at things from an educational side, how can you show them about investment as, being something that should be a part of everyone's integral lives rather than just someone who wants to build a profession out of it,
Yeah, so I think you cannot really, so as a teacher or like as someone who wants to make people financially literate, you cannot really appeal to logic, right? You need to appeal to the emotion. And the emotion of not being able to build adequate wealth to meet their financial goals if they don't start investing now and investing sensibly now. I think that's the way the thought needs to be put across. So teaching them about power of compounding, teaching them about patience, right? Talking about that, right? Rather than stock tips or rather than what to buy, what not to buy. I think what to buy, what not to buy, how to analyze businesses can be learned in 6 months, right? Of course, you need to master them over a period of time, but how to not do anything and sit quietly with patience, right? It's a terrible thing. It's the most difficult skill that you can really build up as an investor. So teaching students whenever you are interacting with them or teaching people how to build that right kind of patience, and what if you don't build that right kind of patience, what happens to your wealth creation over a long period of time. I think these are the most important lessons that you can impart to anyone who wants to set out on investment journey, or I think everyone, because everyone wants to save money, everyone wants to grow their wealth, to meet their financial goals. So I think these are the most important lessons you can teach.
What they say is that market is a brilliant teacher, and a lot of people out there tell you that if you want to learn the art of investing, if you want to participate in the equity markets, then you have to deep dive right into it. What is your sense on this? Is it a good idea to sort of learn on the job sort of a thing, or should you do some amount of solid homework before investing?
No, I think some amount of solid homework is definitely required. It's like swimming, right? When you say deep dive, as a first-time swimmer, you're not going to dive at the deep end of the pool, right? You also need to wet your feet. You need to understand how you can float and how you can survive in the water, right? Then only after you practice for a lot of time, you have to deep dive. The same applies to investing as well. When someone is starting out as an investor, he or she and if he or she wants to really invest in stock markets as like direct equity, they must first understand, as I mentioned, whether they have the required patience to hold businesses for long term. They must understand market cycles. They must understand the behavior of people. They must understand businesses, right? If you don't have the time or inclination of doing anything, or even either one of these things, right, I think you should not be in the markets like as a direct stock picker. You can rather go via the mutual fund route by selecting the right quality mutual funds. But I think straight away deep diving into the market is not a good idea, right? But not wasting time and starting to grow your money, to compound your money early on, right? Even while you're learning the ropes of how to invest well, I think that's a good idea. You should not really waste time doing that. So maybe start with good mutual funds, and then as you learn about businesses, about human behavior, you can start picking stocks over a period of time.
Okay, and for people who are new to investing, do you think the Benjamin Graham intelligent investor, value investing approach is something that's just more easy to acclimatize to because it sticks to the traditional value of long-term value creation? Or do you think today, there are so many other styles of investing which are also quite popular and also giving you fairly decent returns? So do you have any preferences there?
No, I think since you mentioned Ben Graham, if Ben Graham was practicing investing today, right, he wouldn't have done the same things that he preached about in his book in 1930s. Right, he would have been a different kind of investor, looking at the market, looking at people's behavior, looking at the environment overall, right? So I think everyone should be, I think, rather than just practicing what they have learned through books, I think learning through real practice and seeing how they are doing as far as investing is concerned, I think it's very important. Looking at the overall, not the market, but overall scenario, a bigger picture in terms of businesses, because just talking about businesses, I don't have statistics for India, but for example, in the US, maybe 60 years back, an average lifespan of a company was around 50, 60 years. Now the average lifespan of a company in the US has come down to 15, 16 years, right? So if the average lifespan has come down, which means you need to be very, very clear about what kind of businesses you're investing in, right? You cannot simply be a buy and forget kind of investor. You need to buy, of course, you need to buy and hold for the long term, but you have to do an annual review of what your investments are doing, whether business are doing right or not, because in today's time, there are more chances of companies faltering than surviving for a long period of time. So I think times have changed. The principles remain the same, right? The principles of long-term investing, compounding, they are like law of gravity. They don't change at all, margin of safety. But then applying them to the current scenario, the current kind of businesses, what kind of businesses you pick up, I think that's very important. That's a reason investors should be lifelong learners. You cannot really read a book which was written 78 years back, or read a few books and think that you have learned everything.
You just started out by saying that Ben Graham would have had a perhaps different approach or different way of investing had he been doing it right now. But if you look back, what would you have done differently? Perhaps any key lessons or any key mistakes that have really shaped up your investing principles?
Oh yeah, I think mistakes are many. I would not want to embarrass myself on a public channel here, right? But I think maybe starting at 10, when like Buffett started at 10, age 10, I think that would have been an amazing idea, right? To start compounding your money as early as possible, and that's a lesson which I teach to very young people or young kids, right? That start as soon as possible, and it's not just about compounding money; it's about compounding everything, your habits and everything, right? The power of compounding really works over there. So as far as mistakes are concerned, I think, a couple of major mistakes which I think most investors make, holding on to bad businesses for a long period of time, hoping to get my money back, and selling good businesses soon before I could lose my paper profits. So I used to make these mistakes, I think a few years back. Thankfully, I've learned my lesson. I've learned those lessons.
You said that you wish you also had started at 10 and, started thinking finances, perhaps investing as well. That's a regret, or that's something that a lot of us also often talk about, that, only if we had started earlier. But something, out of my own experience when I was growing up, for that matter, there was not enough discussion, enough education among students, or even among college students for that matter, about financial literacy, personal finances, managing your money, how to build your wealth, etc. And not just me, but a lot of people as well who were pursuing business courses, pursuing commerce courses, were not talking about it enough. Why do you think that is? And Has it changed over the years? Because I passed out of school a while back, but has that trend changed? Are kids more interested in this space now? What is your sense?
Uh, I'm sure, I think looking around and traveling to various parts of country and meeting people, I understand that the spread of information has been very well, right? It's been very good, right? Amount of information that people have even in like smaller towns and cities, right, is amazing, right? Compared to a few years back when information was concentrated among like big cities, like you didn't have sources of information all around. But I think because of the spread of information, there also been a spread of noise, right? So even when you go, even when we talk to people in small town and like cities, right? Most of those guys are traders, like they're rarely long-term investors, right? And even if you look at your family members who would have been in the stock market, or my family members who were in the stock market even 20 years back, most of them were traders. They were not really long-term investors. So this gene of instant gratification is so deeply rooted in our psyche, right? That one thing is that even schools and colleges or even MBA courses don't really talk about long-term investing.
Yeah.
I think if I look back at my MBA college, MBA finance textbook, I would be very ashamed of what I learned over there, right, in terms of short-term volatility, beta and capital asset pricing models, which is utter junk that doesn't really work in the real world, right? What works in the real world are simple things that Graham Buffett have talked about, and they actually proven to work for many, many decades now. Right, so these things are not really being taught about. They were never taught about. The course curriculum in schools and colleges still this. Of course, the college is still the same. Schools really don't talk about money. When they talk about money, they talk about currency. Right, they'll introduce kids to currency notes and coins, and that's it. Right, but I think the most important change that needs to happen at the home, right, where kids are actually influenced by what their parents are doing as far as their money habits is concerned. And kids, as I understand, are those creatures who don't really hear what we tell them. They only see what we do, right? And I think everyone behaves like that. So if a parent is not behaving financially well or sensibly and just talking about compounding, the kid is not going to understand the right lessons. So the real learning needs to happen at home, not really, and we cannot really impose that on schools and colleges, right? But definitely financial literacy is something that needs to start early on in life.
So are the kids in your family benefiting from these lessons?
Oh, I'll probably see power compounding. That's compounding how it works. It's back-ended, back-loaded, right? The benefits of compounding are seen not in 5 years, but 15, 20, 25 years. So I need to see those benefits now to be able to really comment. I can say, okay, I am trying to teach, or through my own behavior, trying to teach how to do well or how to be patient. But I think where do they go? I think that's their... I have no idea.
As one more question I have is, as a teacher, what do you say when a student comes to you and says that, okay, all this while you've been teaching me that the stock market is a reflection of the economy, and that if things are inherently good, economically or however micro, macro, whatever, whichever you want to look at, then our stocks will do well. Then how come today the completely reverse of that is happening? As a teacher, what answer would you give your student?
No, I think the best answer is like what Graham talked about. In the short term, it's a voting machine, right? If people get overly emotional and vote the way the stocks work in the short term, right? They ignore economic realities, they ignore the fundamental realities, and it entirely depends on. It's like a fashion show, right? If someone is buying a stock and it's rising up in price, the followers or people around them are going to buy the same kind of stocks because they don't want to miss out on a future rise, right? But in the long term, Graham said it's a weighing machine. So economic fundamentals, business fundamentals really apply to investing or stock valuations over a long period of time. In the short period of time, nobody knows what happens.
Lot of DIY investors out there, they all want to equip themselves with the right books, watching the right content, following the right blogs. But is this a good way to equip yourself intellectually before starting your investing journey? How helpful is it?
I think reading books, blogs, resources is a good idea. It's a good idea definitely to learn from other people's mistakes and other experiences, right? Life is too short to make all the mistakes yourself. But I think the most important book that you would ever read in investing is yourself, right? How you are like attuned, what kind of mind do you have, what kind of psyche do you have the patience or not? Learning about yourself, I think that's the most important resource that you can really have as far as investing is concerned. And of course, there are books, there are super texts written on investing by legendary investors who have proven how long-term investing works, and they have actually shown it. They have actually been teaching like for generations now. So I think it's very important to take up those resources rather than reading all the kind of books that you get across. It doesn't make sense. I think rereading the most important stuff that is already written in investing 50, 60 years or 30, 40 years back, I think that is something which I would advise to people who want to start learning about it. But I think most important thing, first learn about yourself.